Hi, everyone. John Boardman, founder and CEO of Ballast, and I'm thrilled today to be joined by Andy Reynolds, our COO, financial advocate, and partner here at Ballast. And we just wanted to get together and have a conversation about, the election just happened last week. It feels like it's been a month now, the way the news cycles, been rolling. But we basically know the results. Election still has not been certified yet. Some votes are still being counted, but we're getting a lot of questions from clients. And so we thought it'd be a great opportunity to sit down and kind of talk about what we think are some of the implications of this election and some planning maybe leading into year end, and then maybe some things we predict or some things we still don't know leading into 2021. So I'm just going to go ahead and ask you, what are your initial observations about the results of the election and what that means for our client base?
Yeah, I think, the market at least is pricing in optimism over the results. And not that the market cares whether it's a Republican or Democrat, but what we're seeing the market price in is a split Congress, which, obviously that's not been determined either yet, but hopefully we have some news on that shortly. And then a Democrat as our president like Biden potentially. So what that means for the markets really is status quo, which is what markets like. Markets don't like uncertainty, and markets tend to overreact to uncertainty. And so with a split Congress, it's much more difficult to get things done, a lot more gridlock, which we all have seen the times where we're frustrated by that historically. But at the same time, the market can have a general understanding of what things probably will look like over the next 4 years. So, still up for debate how exactly that will play out. But if there is a Democrat and a split Congress, then it's a lot of good things potentially for the market, at least in the near term, as we're trying to filter through the election results. We put together that analysis, or we didn't put together, but we put together several different analysis of what happens in the market and different political outcomes. And I think the two main things to take away from that is, one, the market really doesn't care. The market's done well in any environment, whoever's in the presidential and the White House, and also whoever is in Congress. And surprisingly, to some and maybe not to others, actually when a Democrat is in the White House and we have a split Congress, statistically, we've seen that be the best for the market returns over that 4-year period. So, we're definitely seeing that. We're seeing a little bit of obviously a potential vaccine coming sooner rather than later. We're seeing some beginning of margin expansion over time. Unemployment's down. So generally right now, I think the market's happy. That can flip on a dime, obviously, but right now the market is starting to be more optimistic and continue to be more optimistic about what 2021 may bring for us. So thinking about elections, what I know recently you're working with some clients with some tax planning and potential tax changes, and while gridlock may or may not happen, what are you thinking about right now with clients with taxes and looking at the end of the year, or just what changes might be coming down the road?
Yeah. I think it's interesting. If you look back to 2016, I think the expectation out of that election is that we would have a sort of a gridlock situation. Hillary Clinton was favored in the polls, and obviously that didn't come to fruition. And then we woke up to Republican control. And in that immediate, 6 months, we saw quite a bit of legislation introduced. We saw some tax cuts happen, and that was a different type of tax planning, right? That was one where we were sort of waiting for potentially more opportunistic tax planning. Now, in speaking with attorneys, and this is consistent with attorneys we're working with in different states across the country with clients, there is a little anxiety leading into the end of the year. We still don't know, as you said, what Congress will look like. And with the Senate runoffs in Georgia, that will dictate probably what the legislative agenda looks like for the beginning of 2021. My impression in the estate planning community is that most attorneys are advocating for fairly proactive tax planning leading into the end of the year. There is the largest exemption, the estate and gift tax exemption, is a huge opportunity for high net worth individuals to pass assets down to the next generation. There is some concern that if it's a full Democratic control, that might get closed up, or that limit might get lowered to a much smaller number. I think that there are a lot of things have to come into to play out for that to be the case, but I can see in certain situations where clients will be best served by going ahead and sort of preventatively and proactively making gifts to family members if that is in fact a concern. The income tax side of it is a big question mark, and there's a lot of misinformation out there about what the Biden tax plan is versus the current tax plan. Generally speaking, those most targeted by some potential tax change would be the highest of income earners. I don't believe, based on my understanding of what a potential tax plan proposal would look like, that it will greatly impact that many people. Now, the markets may care about that, and the corporate tax side of it could be a factor as well. That one, I think, will be a little bit more politically challenging to deal with. So there's just still a lot up in the air, unfortunately. I thought we'd have a little bit of clarity. That was sort of how we had tabled some conversations with clients. We weren't expecting a state with 2 runoffs that would dictate political control in the Senate, but that's where we are right now. Let's just sort of jump away from politics a little bit and just think about, with the business owners you're working with, just a general take on what the economic environment looks like now, and both from a small business standpoint, the business owners we deal with, but also to a larger sort of perspective on just industries and how they're dealing with this window.
I think one thing that I've heard a lot of is, so anytime when there's something bad, there's always some silver linings. And I think one of the silver linings from this, as we've talked about before, is one of the benefits of how this all played itself out is all businesses were forced to close, forced to take a hiatus. And what a lot of good business owners did during that time period is they stopped and they thought about how they could improve their businesses. So you're seeing some of that come out in how they're attacking the end of the year, how they're attacking next year. And I think that will ultimately be good. You see a lot of that in small businesses. We have a friend of someone in our office who was making leather goods, and all of a sudden they transitioned and made face shields. And had they not have done that and just sat at home, their business would look very different. So you saw a lot of that, and I think that's helped small businesses who are nimble be able to provide a bridge across these time periods. Looking at other industries for bigger business, there are some that are struggling. There's no sugarcoating it, and there's some that may not come back, and that's unfortunate. This has definitely exacerbated change that was already happening, whether it's in the business standpoint or government or college or whatnot. It is fast forwarded time, I think, for some of those struggles and brought them higher in people's opinion. But looking forward, similar back to the financial crisis, if you think about what happened with companies and their profit loss statements, margins began to actually grow on the back end of the financial crisis. Top line revenue took a while to actually grow, and that was the headline news for years of when are we going to see top line growth. But bottom line growth, we actually saw companies that were just as or more profitable. I think we'll continue to see that. My opinion is I don't think that we are at a point where there was exorbitant risk-taking or exorbitant excess in companies, but we are getting there. And you're starting to see companies taking a step back and realizing, we actually didn't need that. We didn't need that. We didn't need that, and we can still function. It was nice to have those things, but we don't have to have those. So you're starting to see some of that. There are a lot of analysts out there as we've talked about, that think 2021 could be significant growth for a lot of these companies. Part of it's going to be from pent-up demand, assuming that people are able to get out and do things next summer. Part of it's going to be just good business decision making and really trying to drive margins. Haven't talked about the vaccine, but that obviously has an impact, connecting a bridge between a day of complete uncertainty when we don't know what the future could look like to a day of, okay, we're starting to have a better understanding of what that might look like. Talk a little bit about your thoughts on the vaccine and where that brings us as we start to learn more and more about what it could look like.
Yeah, I mean, the markets a couple days ago when the Pfizer news came out, that was obviously a real positive, and 90% effective, which probably some ways to punch holes in those numbers, but generally positive news about it. Markets reacted well to it. There's so many aspects to the vaccine that I think will determine how effective it is, not just scientifically, but there's a confidence issue right now. A lot of it, I think, is because it was just such a this pandemic has been so political, likely because it was just an election year. I think any election year would have made that a political issue, but when people don't have confidence around taking the vaccine, if a large percentage of the population, for instance, doesn't have confidence around the vaccine, that is going to be a headwind for the efficacy of the vaccine, because you really need people in mass taking it. So there's a scientific side of it, and then there's the confidence level, and then you just have general, distribution capability. Which I know there are a number of manufacturers already working on a number of different types of vaccines, but that is going to be critical if we want 2021 to have any semblance of normalcy, even if we're talking about the latter half of the year or latter 3/4 of the year. We need that vaccine. We need it out in a big way in the first quarter. I think there is a huge pent-up demand in consumers for just living, whether it's travel, to see family, spring breaks that were canceled, summer vacations that were canceled. I think that pent-up wave of demand is just waiting and will be a real win for those industries. Unfortunately, there will probably be some individual companies that don't survive this environment just because it's been so stressful. I do think it's going to be required. A vaccine is going to be required for us to get back to normal. There's just nothing in this current environment that tells me that we're going to be able to adjust without a vaccine. Herd immunity, which we've all become scientific experts right through this entire thing. We all we hear these terms that we just didn't talk about before. But herd immunity, is the other way of getting there. But that, based on what I've read, could take years without a vaccine. So that vaccine essentially would speed up that process. So I'm optimistic. I'm an optimist by nature. I know you are as well. I think as investment professionals, you have to be optimistic that the world will figure these issues out. It will be a transformational period for companies and industries, though. I think consumers will change the way that they behave. Companies will change the way they behave. You mentioned the idea of employment or of efficiency and productivity. Coming out of the financial crisis, one of the concerns was the corporate conservatism that set in. Yeah. And then a lot of these companies that just really got stuck in a tough position became very conservative with hiring. So we may see corporate profits really take off because these companies become that much more efficient to operate. But we hope that doesn't happen at the cost of a weakening consumer base where employment really is challenged. And that could be impactful. And I feel like, although we've seen a lot of layoffs this year, I am concerned that over the next 6 to 12 months, we'll see more as companies start to deal with what they have once the dust settles, so to speak, on this issue. So I think it's there's a lot still to play out.
Yeah, and that conservatism lasted a long time, right? It wasn't a year or two.
I think it still is there to some degree.
I agree, and I think that's what's kept us from that ultimate. If you think back, beginning of the year and behind, things were rolling. They were doing pretty well, but still there was in the back of the mind there was a thought process of of fear of that quick memory back to the financial crisis. And then just another point to add about the vaccine, I do think one thing that's promising about the Pfizer news and Moderna coming out this morning, with their trial now being able to go to review the results, it allows us to have some degree of near term of when we might be working our way out of this. Maybe it's not the end of the year, maybe it's next summer, but that company, like movie theaters, if you're a movie theater right now and you have no end in sight, you may just close it down and say, we're done. But if that end in sight might be 6 months from now, maybe, or 9 months or a year from now, you might be willing to take that loan, and a bank might be willing to loan you the money to provide that bridge. And it may take you 5 years to get out from underneath of it, but the future is back in reality again.
Yeah, I think the confidence that just the confidence in the news that came out that said this is in fact working in the people we're testing.
Right.
You're right. I mean, it's the phrase that was said at the beginning of this. I said, well, every day is one step closer to us being done with this. And quite frankly, after 8 months of this, it almost felt like you couldn't envision when we wouldn't be wearing masks on the regular, and I think that is really important just from a confidence standpoint, so people know that the end is in sight. Let's talk a little bit about sort of diving into the markets a little bit more and thinking about asset classes and sort of what we've witnessed around the election and since then, and in this COVID world we're in, and maybe what a post-COVID world could look like. I know there's been some disparity in performance in different asset classes. What are some of your thoughts there?
Yeah, it's we've talked about FANG. Everyone's familiar with that term, and now the new term is the stay-at-home stocks. It's definitely been, if we just focus on large cap, it's definitely been a growth versus value story over the past several years. Since the vaccine came out, we saw initially a big divergence of those two actually favoring value. We talked about this last time we talked, and we continue to talk to clients about it, and we all love the growth names, and don't get me wrong about that. If you look around you and where you spend your time, your activities, a lot of them are going to be in those growth names. But I heard a recent comparison to Microsoft back in the 90s. And back in the 90s, Microsoft did fantastic. I think it was up 9,000+% during the 90s leading up to the tech bubble. After the tech bubble, I believe it took 16 years for the stock price to get back to where it was from the peak of the 90s. So why is that? Was Microsoft a terrible company? No, it was still a great company, but at some point reality has to set in these valuations. And when that point is, who knows? Probably sooner rather than later, but may not be. But at some point, these companies aren't going to be less favorable. I mean, Apple, as an example, is a great company. Its PE ratio is starting to go up tremendously. At some point, we have to look at it for the merits of what it is. And we also have to recognize that for it to continue to grow at that pace and get back to a realistic PE ratio, it's got to do everything right, and it's got to continually get those decisions right. So I think, that's something we're focusing on a lot. I think, pre-pandemic, pandemic, post-pandemic, all those worlds look very different, and what companies could really outpace could change over that time period. Especially with these stay-at-home stock names. I mean, Zoom video. Zoom's great, and this has really pushed Zoom ahead of where it would have been. But what percentage of people are going to be using Zoom in 2 years from now? I can promise you, hopefully, if we're not still in this COVID world, it's going to be a whole lot less than we're using it now. Now, are we going to use it more than we did pre-pandemic? Probably. But we're not going to use it anywhere near the amount we're using it today. So reality will start to set in with a lot of these names. And I don't think you want to be on the wrong side of that when that reality does set in, because I think that's an equation for potential disaster. And you got to remember, these value names, they're not old dinosaurs that aren't doing anything. They're still really good companies.
Yeah.
They just are having capital flow to them a little bit slower than some of the more sexy names that we're seeing.
Yeah, I think these growth names, typically you would just think of being more speculative. You're buying some future vision of what these companies will be, but I think over the last couple of years, they've almost become safe harbor assets where people are putting money into them because they know what they are. They look at some of these more traditional names and they have a hard time envisioning how they'll be able to evolve. Right. But you said it exactly. I mean, valuations at some point eventually will have to matter.
Yeah, there was, I really like this. I heard someone refer to people who are invested, own a part of those companies, are supporters of those companies. Less investors nowadays. Are you truly investing in a company, Peloton? Are you really investing in a company that its earnings are, far exceeding any revenue it's making?
Right.
At some point, you're a supporter of what that could end up being, but not what it is today.
That's right.
And it's something to keep in mind. So, knowing that, there's a lot of things at hand right now. The election, we have a general idea of where it's going to go, but it's definitely not set in stone. We have a COVID world. We have a potential vaccine. We have large cap disparity. What do you see being a driver of economic growth, being a driver of markets looking forward as we finish the year and move into 2021?
Yeah, it's a good question. I mean, the IMF, and this was before the election, they came out and did lower growth forecasts globally for the next few years. And I think much of that has to do with this. I think when the pandemic started, we thought, this will sort of come and go, and in the fall we'll be back to normal. Well, we're approaching winter now, and numbers are not necessarily improving. So I think there is going to be a hangover impact from these. From the pandemic that we're in right now. I also think that the markets, I want to say they've been derailed, so to speak, but so many companies did suspend guidance during this period of time. We really don't know where these companies are going to end up. So from a market standpoint, my hope would be that we return to some sort of a fundamental type market where earnings do matter and growth does matter and balance sheets do matter. I think, for those of us that like to look at fundamentals as the driver of long-term values, that's what we would hope. From an economic standpoint, I do think there will be, like I said, a pent-up demand. I think there will be a little bit of a tailwind with just general activity people want to do, things that they were unable to do this past year. Low interest rates look like they're going to be in place for a while. There's not a lot of wage inflation, which is something we would typically need to see for rates to go up. There's obviously variables out there that could cause interest rates to move up that are outside of inflation, but if that continues to be the case, that could prove to be a good tailwind or sort of enhancer to economic conditions if rates stay low. It's interesting just talking to people and what businesses have thrived in the middle of this. People are staying home more. I heard, for instance, of a client of ours putting a pool in, the contractors were 2 years backlogged. So there's just certain areas and I think things that people are going to say, you know what, I'm going to enjoy my time with my family. You have kids in the house or you're retired and say, I'm going to actually enjoy, I'm going to do some things that I've always wanted to do because who knows when I might not be able to do it again. So I think there are some real positives out there that could drive consumer behavior where people will just have this newfound appreciation for all the things that they sort of took for granted. Globally, I think, we're all in this together. There is some reason to believe that the United States may bounce back a little bit quicker than some of the European countries dealing with this. I think I said this at the beginning. I think American stubbornness that maybe kind of extended our problem more than some areas will probably be the thing that helps us be most resilient coming out of it. So I think that there will be some disparity in how countries deal with this, and going back to the vaccine, how quickly they're able and how confidently they're able to distribute that. So there's still just a ton of variables. I mean, the political landscape that we touched on at the beginning, that is going to have a huge impact on how companies think about spending and reinvesting. I think a status quo, so to speak, where we didn't have a lot of legislative change, I think generally that would be a good thing for the economy and the markets. But that's just pure speculation at this point.
I think it'll be interesting to see whenever we do get past COVID, vaccine, or some semblance of that, what the market looks at when it takes a step back and kind of comes back to reality. Because, just think of an example. Your house is on fire. You're going to do everything you got to do to make your house, not be on fire and provide for your family and whatnot. After that, though, you still got to figure out how you're going to pay your mortgage. And, if we look at the underlying concerns that we had before the pandemic, those things haven't changed at all.
That's right.
Trade with China, government debt has only gotten worse. Where we go and where what the market focuses on, what becomes headline news when the pandemic's in our rearview mirror, is going to be really interesting as well.
I agree. So now that we've touched on some of the economic headlines, and I think we should probably reconvene before the end of the year too, just to kind of see what has materialized between now and then. What are some of the things you're talking to clients about, leading into the end of the year? And with what we know or don't know about the election and current tax laws, what are some, and we know we didn't have to do required minimum distributions this year. What are a few of the things you've been touching on with clients?
Yeah, so it's definitely a continually moving story. Tomorrow we could have a different election result. Tomorrow COVID could be on its way in our rearview mirror. So a lot of moving pieces. I agree, staying up to date on all those things is really important. Really what I think we're trying to focus on with clients is just, we're not out of the woods yet. Things are looking better. People, I think, are starting to get tired of dealing with bigger things, but really trying to focus on looking at the next 6 to 12 months in your own personal life and what you need to do to make sure you're in a good position. Taking a step back, you've seen the good, the bad this year over the past 18 months, focusing on those. And then really just trying to make good decisions. We'll be doing tax planning within the portfolios, but trying to make good fundamental decisions, unemotional decisions as you take a full picture of your complete financial situation.
Yeah, I think it's there's been so much drama around this election, and I think it's a great time for people. We have people that are falling off the ends of both political edges, right? And so everyone is going to come out of this election with sort of a different opinion on how healthy the world is, and I think whenever emotion sort of starts to pull into your own financial picture and you're starting to think about it from that perspective, the best thing you can do is talk to us, and sit down and think about actually fundamentally where you are, what are some practical decisions, and let us remove the emotion from the situation, because I think that's one of the things that drives people often to making short-term, potentially destructive decisions, if they don't remove emotion from the picture. So, well, thanks for joining me today. Yeah. We'll definitely reconvene and do this again soon, and we thank everyone for listening in. Hope to see you soon.